Bonds are forcing interest rates higher. Let's have a look. Hello everyone, Florian Heiser here, and welcome to another episode of Heiser Says. Grab your stein of coffee. I want to have a talk about an article from ABC discussing, the bond yield targets and how the RBA isn't addressing them. They're not keeping them down, everyone. Have they given up? Now, will this drive interest rates higher? I'm going to bring this chart here, which I have purposely not updated for some time, showing our cash rate at 0.1%. Now, the RBA has promised us. Philip Lowe has promised us he's not going to raise the cash rate until 2024. But, they haven't managed to keep yields under control, have they? So what's going to happen here? Will they raise the cash rate? I don't think any of us will at all be surprised, particularly, considering this lovely chart I love showing here with the value of the RBA to predict wage price growth. There you go. 11, 12, 13, 14, 15. They keep failing again and again. And this is probably why, or this is the fact that we're in GDP anyway, wrong chart. But this is probably why so many of us have locked in our mortgages, because we just don't trust them. Sure, we may, honestly, we might actually make some money. If interest rates go up high enough, you're locked in for a year. You might be making more on your savings than on your what you're paying for your mortgage. Anyway, let's look. So traders have forced the RBA into submission, with the RBA declining to enter the market to buy April 2024 federal government bonds to defend its interest rate target. The Reserve Bank has maintained a 0.1% yield target on the 3-year Commonwealth debt that matures in April 2024. But market traders have recently repeatedly pushed the return on those bonds substantially above that benchmark. After rising steadily over the past week, the yield on those bonds was sitting around 0.25%, before more than doubling yesterday to sit above 0.5%, or more than 5 times the Reserve Bank's target level. That move came on the back of stronger than expected September quarter inflation figures on Wednesday. That was seen by traders as increasing the chance of an official interest rate rise before 2024, which is when the RBA has been forecasting the first move up. Now, the concern is here. You have a lot of people that have bought into the market. A lot of first home buyers have bought into the market. The government stimulated the housing sector. You've got the home builder grants, guys. Let me bring this up here if we can see just how big it's gone. You've got loan deferrals propping up the market, guys. You've got government debt going to the moon. You've got home builder. Tens of thousands of people have bought homes. A lot of them built it. Building approvals shot up. Skyrocketed, everyone. The market is overheating in construction. Now, how many of those people, of those first home buyers, have gone in right at the edge? Now, not as many as you might suspect. There are a lot of people that are putting their hands up in the air and terrified about the banks just willy-nilly handing out mortgages, but they have to have decent buffers on interest rate padding. So that, you get an interest rate at this level, they need to have a few percentage points higher to make sure you can meet your repayments. And honestly, it may just mean some people may not live the luxurious life that they're used to, but then the real concern of that is that would flow on to reduced spending in other parts of the economy as people are trimming down and cutting back to keep making their mortgage repayments. And that's what they don't want. They want houses to keep going up. They want you to keep feeling richer and richer, borrowing more and just spending to keep it all moving. Today, the RBA had an opportunity to step into the market to buy April 2024 Australian government bonds. Its purchases would have pushed the price of those bonds up, therefore pushing the yield or return on them down closer to its 0.1% target level. However, the RBA did not bid for any of those bonds today, perhaps deciding that the market moves betting on rising rates were too strong to successfully fight against. Since the RBA passed up the opportunity to buy today, the yield on those bonds briefly climbed to 0.823%, or more than 8 times the RBA's target level, before easing back slightly to 0.73 by 4:20 Australian Eastern Standard Time. So why does this matter? The Reserve Bank has been targeting the April 2024 government bond, which is a key benchmark interest rate to push long-term interest rates down through a mechanism known as yield curve control. This has been a key part of its current commitment to record low interest rates now and out until at least 2024. This commitment of forward guidance, as it is known on the markets, is a major reason why Australians enjoy some of the lowest fixed mortgage rates they've ever seen earlier this year. However, those ultra-cheap long-term fixed loans, long-term 5 years, have already been disappearing as global markets noted rising inflation across most of the world and started betting that central banks would begin lifting interest rates earlier than previously thought. New Zealand, Norway, South Korea, and Singapore have already recently lifted official interest rates, while the UK is considering a move as early as next month, and the US Federal Reserve is expected to start withdrawing some fiscal stimulus this year. And we've had a look at this in previous videos about how all the major fours are starting to increase their rates. The most recent figures from Rate City show that 18 lenders have increased their 4- and 5-year mortgage rates over the past month, while none have cut them. Even 2- and 3-year fixed mortgages are generally becoming more expensive, with only 2 lenders cutting 3-year fixed rates, but 22 rising them. The only area where rates are generally still falling for new mortgages are 1-year honeymoon fixed rates and variable loans, where more lenders are still cutting than rising. Traders and analysts are now expecting that the Reserve Bank will weaken or abandon its yield target on the April 2024 bond when it meets next Tuesday, along with a change in its forward guidance on interest rates. The RBA chose not to intervene to defend the 10 basis point yield curve control target this week. This is a very significant surprise. However, having done so just last Friday, noted JP Morgan, Ben Jarman. The only conclusion we can draw is that the yield curve control regime is about to be formally dumped at next week's meeting. If so, this is a startling about phase. Is anyone at all surprised, guys? That's why we all locked in. Now the problem is, people have locked in, and then the lock-in period expires, and boom, repayments shoot up. So you got to build a buffer. Build a buffer. So in the short term, that is likely to see fixed mortgage rates rise even further as banks price in an earlier official RBA interest rate rise. So when will variable mortgage interest rates rise? That has prompted the market to price in official interest rate rises as early as next year. In fact, the market is currently pricing in 4 rate rises next year, which could take the cash rate down close to 1% from just 0.1% now. However, while most economists now agree there will be an RBA cash rate hikes before 2024, the majority still expect the first of those in early mid-2023, not next year. The current forward guidance is dead and buried. Justin Farbo, senior economist, and Macquarie told Reuters. However, in terms of market pricing, I still feel it's too bullish. Directionality, it's right. Like everywhere in the world, but factoring in a cash rate of nearly 1% by the end of next year seems a small chance to me. NAB economics team agrees. It has brought forward its forecast date of the first official rate rise to mid-2023, but it then predicts rates will climb quickly to 1.75 to 2% by the end of 2024. If passed on in full by lenders, such a rate increase would add about $500 a month onto the repayments of a $500,000 30-year mortgage. Well, yeah, if we're talking about a 2% increase, yeah. The Reserve Bank meets on Tuesday, and markets are pricing in around a 1% chance of a rate rise. That means essentially no one expects the cash rate to move next month or this year, and the RBA does not generally meet in January or February, so the first meeting at which any kind of rate move could be considered even remotely possible. However, Mr. Jarman noted that today's non-move would make the RBA's post-meeting statement on Tuesday and more detailed statement on monetary policy on Friday next week closely scrutinized. Dropping yield curve control is a strong signal, so we bring forward our expectations for the first hike from late 2023 to the fourth quarter of 22. Pending the guidance of next week's board announcement, he wrote. So, guys, well, what are we seeing here, everyone? What are we seeing here? Now, here's the thing. If they've given up yield curve control and rates are going to rise earlier than anticipated, I'm not entirely surprised. I don't think anyone else is surprised. I suspect that's why so many people jumped in to secure their mortgage. Now the question is, if rates rise 1 or 2%, will people be too close to the edge and will it start affecting the market? Now, here's the thing. I don't think we're going to see a big hit to it, guys. I'm going to bring up these old charts. You can see here people have made significant prepayments on their mortgages and households have liquidity buffers. Plus the banks have taken account of, well, they've got buffers on the interest rates that you have to pay, everyone. So it's not, well, I don't think it'll be as drastic an impact. If anything, it's going to slow down the property market. And it's going so hot, they want to slow it down. That's the concern. We're starting to see inflation. We're starting to see houses just continue to grow. So will it cool down? Will we see a dip in house prices? We'll have to see, guys. Hey, if that happens, don't worry. They can always just pull out Mortgage Keeper, guys. So I'd like you to have a look at this video I did some time ago about QE coming to Australia. And let's see how that goes. If they can step away and stop buying these bonds, or if they're going to jump back in. Take care, guys. Thanks for watching, and I'll see you in the next video. Bye for now.